Welcome to the Finance Wisdom Summaries. The Four Pillars of Investing. Introduction. The Four Pillars of Investing by William J. Bernstein, a renowned author and financial expert, emphasizes a vital and simple message for building a winning portfolio: understanding the fundamental principles of investing. John C. Bogle, founder of Vanguard, praises the book for its renewed wisdom, stating that reading it is like meeting an old friend who brings new wisdom into your life. This new edition also features a postscript on the economic collapse. The book aims to provide lessons for building a winning portfolio, as indicated by its full title. Bernstein, originally trained in the sciences and medicine, observed that many professionals, including doctors, often neglect the scientific basis of finance when investing. He highlights that learning to invest properly doesn't require excessive effort, and that the best doctors recognize the limits of their knowledge, a principle equally true in finance. Key takeaways. Investing has a scientific basis often overlooked by professionals. Effective investing relies on understanding four core pillars: theory, history, psychology, and the business of investing. Daily application. Approach investing like a science. Don't rely on gut feelings or common advice from non-expert sources like daily newspapers or stockbrokers. Instead, seek out information from reputable, peer-reviewed financial literature, much like a doctor would consult medical journals. Pillar 1. The theory of investing. Pillar 1 delves into the foundational theories that govern investing, emphasizing the intrinsic link between risk and return. Bernstein argues that without understanding these core concepts, investors are doomed to failure. Key takeaways. Risk and reward are inseparable. The most fundamental characteristic of any investment is that its return and risk are directly correlated. Higher potential returns invariably come with higher stomach-churning risk, while safer assets offer lower returns. Historical returns are deceptive. Looking solely at impressive historical gains, such as $1 invested in the U.S. stock market in 1790 growing to over $23 million by 2000, is misleading. These figures often ignore crucial factors, such as regular spending, commissions, taxes, and survivorship bias, where only successful outcomes are recorded. For example, a 1% annual reduction in return due to spending or fees could reduce the final amount from $23 million to around $3 million. Measuring risk. Short-term risk can be measured by standard deviation, which indicates the scatter of values around an average. For instance, the U.S. stock market has an average annual return of about 10% with a standard deviation of 20%. Long-term risk, however, is the probability of running out of money over decades. The market is smarter. Almost all differences in money managers' performances are due to luck, not skill. Attempting to pick top-performing stocks, mutual funds, or brokers is unlikely to be rewarded. Diversification is the biggest risk of all, failing to diversify properly. The overall behavior of a portfolio, rather than its individual assets, matters most, and a portfolio can behave radically differently from its components. Inverse relationship between price and future returns. A crucial concept often missed by small investors is that high previous returns usually indicate low future returns and vice versa. Buying when prices are low is inherently scary due to associated catastrophe and risk. Notes for daily application. Evaluate risk tolerance first. Before building a portfolio, honestly assess your ability to withstand losses. Do not aim for a specific return without first understanding the inherent risks involved. Be skeptical of sure things. If an investment promises high returns with low risk, it's a red flag for potential fraud. Prioritize diversification. Instead of trying to pick individual winners, focus on owning a broad market index to minimize the biggest risk: lack of diversification. Think long-term. Short-term market fluctuations are largely random and unpredictable. Focus on the long-term behavior of your portfolio as a whole rather than the daily ups and downs of individual assets. Challenge conventional wisdom. Be wary when everyone knows an asset is a good investment, as this often means prices are high and future returns will be low. Pillar 2, the theory of investing, continued, measuring the beast. Chapter 2 continues Pillar 1, focusing on how to estimate future returns, particularly through Irving Fisher's discounted dividend model and the Gordon equation. Key takeaways. Intrinsic value of an investment. According to Irving Fisher, The value of any asset, stock, bond, or real estate is simply the present value of its future income stream. This separates true investments, income-producing assets, from speculations, assets whose return depends on a greater fool paying a higher price later. The discounted dividend model, DDM. This model is crucial for estimating the expected returns of stocks and bonds. It works by discounting future dividend payments back to their present value, considering factors like the time to wait, inflation, societal impatience for future consumption, the real rate of interest, and the risk of not receiving the income. Inverse relationship between discount rate, DR, and present value. A higher DR, reflecting a higher perceived risk or inflation, leads to a lower present value for future income. The Gordon equation. This powerful formula is derived from the DDM and accurately predicts long-term stock market returns. DR, market return, equals dividend yield plus dividend growth. For example, historically, a 4.5% average dividend yield plus 4.5% dividend growth equaled a 9.09% return, close to the actual 9.89%. Bond returns are expected to be in a similar range. Speculative return versus fundamental return. John Bogle distinguishes between speculative return, short-term price fluctuations due to changes in dividend or PE multiples, and fundamental return, long-term increase in value from dividend growth and yield. Fundamental return is somewhat predictable in the very long term, while speculative return is unpredictable. Good companies are bad stocks. Counterintuitively, the market tends to demand a higher expected return from riskier, bad value companies than from safer, good growth companies. This drives the prices of bad companies down, leading to higher expected future returns for them. Real returns are key for planning. Investors should think in real or inflation-adjusted terms for financial planning, as it simplifies understanding purchasing power over time. Expected real returns, as of the book's writing, are near zero for cash, about 3% for bonds, and around 3.5% for general stocks. Notes for daily application. Focus on income streams. When evaluating an investment, consider the future income it's expected to generate rather than just its current price or recent appreciation. Calculate expected returns. Use the Gordon equation to get a realistic long-term expectation for market returns. Don't be swayed by media speculation about short-term market direction. Avoid overpaying for growth. Resist the temptation to invest heavily in glamorous or new economy companies that have very high valuations, PE ratios, as their future returns are likely to be lower. Embrace value investing. Consider allocating a portion of your portfolio to value stocks, companies that are often unglamorous or poorly run, but trade at lower prices, implying higher expected returns for them. Understand societal risk. When perceived societal risk is low, for example during boom times, asset prices are high and future returns are low. Conversely, high perceived risk, example during market downturns, can lead to lower prices and higher future returns. Pillar 3. The market is smarter than you are. Chapter 3 argues that individual investors and even most professionals cannot consistently beat the market. This pillar introduces the efficient market hypothesis and debunks common myths about investment skill. Key takeaways. Welcome to Randovia. The world of investing often resembles Randovia, a hypothetical country where chimpanzees pick stocks by throwing darts. While some chimps will be lucky and achieve high returns, past performance has no bearing on future performance, and the average chimp's return will be the market's return minus expenses. No evidence of stock picking skill. Decades of financial research, starting with Alfred Kals's III's work in the 1930s and Michael Jensen's study of mutual funds in the 1960s, have consistently shown that most investment professionals cannot consistently beat the market. Best managers often achieve their results through luck. Persistence is rare. Superior performance by fund managers is typically short-lived. Investing in last year's top performers rarely guarantees future outperformance and often leads to underperformance. Survivorship bias. Studies on fund performance often underestimate the case against active management by only including surviving funds, ignoring those that close due to poor performance. Asset bloat. Successful fund managers often attract massive inflows of hot money, leading to asset bloat, which makes it difficult for them to invest effectively without incurring impact costs, the negative effect of large trades on prices, which ultimately erodes returns for shareholders. Pension funds underperform. Even the nation's largest and most sophisticated pension plans, with access to top-tier resources, largely underperform simple index mixes. Market timing is a fool's errand. There is no evidence that anyone, including market strategists or newsletter writers, can consistently time the market. Their predictions are often wrong. Efficient market hypothesis, or EMH. This concept states that all publicly and most privately available information is already factored into stock prices. Therefore, it's nearly impossible to consistently profit from analysis, as prices instantly reflect collective judgment. The Williams sisters analogy. When you trade stocks, you're often competing against highly sophisticated professionals, like the Williams sisters, who have superior information and trading abilities. High costs of active management. Beyond explicit expense ratios, investors in actively managed funds incur hidden costs like commissions, bid-ask spreads, and market impact costs, which significantly erode returns. These costs are highest for small-cap and emerging market funds. Indexing guarantees the market return. The most reliable way to achieve a satisfying return is to invest in index funds, which aim to replicate the market's performance with minimal expenses. Lack of diversification is dangerous. Concentrating a portfolio in a few stocks maximizes both the chance of superb results and the chance of becoming poor. Owning the whole market, indexing, minimizes both extremes by guaranteeing the market return. Notes for daily application. Avoid active fund managers. Don't chase past performance. Instead, opt for low-cost index funds. Be skeptical of gurus and market forecasts. Understand that financial journalists and market strategists are often selling entertainment rather than actionable insights. Their predictions are unreliable. Minimize trading. Frequent trading, especially with large sums, incurs significant costs like commissions, spreads, and impact costs that erode returns. Diversify broadly. Instead of attempting to pick individual stocks, invest in broad market index funds to ensure adequate diversification and avoid idiosyncratic risks. Focus on what you can control. Since market timing and stock picking are futile, concentrate on factors you can control: asset allocation and minimizing expenses. Consider taxes. Be aware of how actively managed funds can generate significant capital gains taxes, especially in taxable accounts. Tax-efficient index funds can help mitigate this. Pillar 4. The business of investing. Continued. Your broker is not your buddy. Chapter 9 exposes the inherent conflicts of interest in the retail brokerage industry, warning investors that brokers' incentives are often diametrically opposed to their clients' best interests. Key takeaways. The Chernovia of brokerage. The retail brokerage industry often operates with minimal educational requirements for brokers, requiring only a Series 7 exam pass, and lacks fiduciary responsibility towards clients. This creates a system where brokers' interests, maximizing commissions, diverge sharply from clients' interests, minimizing turnover and fees. Betrayal of Charlie Merrill's vision. Charles Edward Merrill, founder of Merrill Lynch, initially aimed to restore public confidence by paying brokers a salary instead of commissions and prioritizing client interests. However, this vision was betrayed when the firm reverted to commission-based compensation due to broker defections and market pressures. Broker compensation structures. Brokers primarily earn income through commissions on trades and spreads, the difference between buying and selling prices. They're incentivized to encourage excessive trading, often leading to churning of client accounts. Principal transactions and specials. Brokerage firms often act as principal, selling securities directly from their own inventory rather than as an agent. This allows them to profit from the spread and unload undesirable, high commission specials, often newly underwritten stocks or bonds, onto unsuspecting clients. Biased research and recommendations. Brokers' stock picks often come from internal squawk boxes, where analysts' recommendations are influenced by their firm's investment banking business, leading to biased advice, for example, rarely issuing sell recommendations. Hidden costs. Beyond explicit commissions, clients incur significant hidden costs like internal firm fees and spreads on principal transactions, which can amount to a substantial percentage of assets annually, example 2% to 5%. Focus on sales, not returns. Brokers are primarily trained in sales techniques, not financial expertise, and pay little attention to their clients' actual investment returns. Country club syndrome. Wealthy investors seeking exclusivity often fall prey to expensive private money managers, hedge funds, and limited partnerships that come with high fees and opaque performance. Notes for daily application. Avoid full-service brokers. Understand that their business model inherently creates conflicts of interest. Seek fee-only advisors. If you decide to hire a financial advisor, ensure they are compensated solely by fees you pay directly, not through commissions or payments from investment products they sell. Be aware of hidden fees. Recognize that your investment returns are directly reduced by every penny paid in commissions, spreads, and hidden fees. Do your own research. Don't rely on hot tips or recommendations from brokers, as these are often biased and late to the market. Question high costs. Be extremely skeptical of investment products that carry high sales fees, loads, or excessive ongoing charges, such as many variable annuities. Pillar 5. The Business of Investing. Continued. Neither is your mutual fund. Chapter 10 continues the discussion on the investment business, focusing on the mutual fund industry and its own set of pitfalls, even though it is generally more transparent than the brokerage world. Key takeaways. Load funds are a trap. Mutual funds that charge a sales fee, load, upfront, upon sale, or on an ongoing basis, for example, 12b1 fees, offer less than nothing in return. These fees significantly erode returns without providing any performance advantage over no-load funds. Variable annuities, VAs. These insurance products often come with high sales fees and ongoing insurance charges, outweighing their potential tax deferral benefits, especially if held in tax-sheltered retirement accounts where deferral is unnecessary. Transparency versus alignment of interests. While the mutual fund industry is much more transparent than the brokerage, with readily available performance and expense data, a key conflict of interest remains. Fund companies profit from gathering assets regardless of how well their funds perform for shareholders. Gunning the fund. Fund companies strategically advertise funds with recent strong performance, hot money, to attract new assets. This leads to asset bloat and increased impact costs, ultimately hurting future returns for investors who chase performance. Mutual fund hierarchy of happiness. At the top is the fund family, collecting fees, then the fund manager, with high salary and potential for future opportunities, and at the bottom are the shareholders, who suffer from high fees and asset bloat. Morningstar's unpopular fund strategy. Research shows that unpopular fund categories tend to outperform popular ones, highlighting the dangers of performance chasing and the mean reversion tendency of asset classes. 401k and defined contribution plans. These plans, while popular with employers, often have high hidden costs and inadequate diversification, leading to significantly lower returns for employees compared to traditional defined benefit plans. Vanguard's unique model. John C. Bogle's Vanguard Group stands out due to its unique mutual ownership structure, owned by the funds, which are owned by the shareholders. This structure incentivizes low costs and aligns Vanguard's interests with its shareholders, leading to lower fees across its offerings. Exchange-traded funds, ETFs. While similar to mutual funds and often low cost, ETFs have some disadvantages, including commissions, spreads, and potential institutional instability, making traditional open-end index funds generally preferable for most investors, especially in taxable accounts. Notes for daily application. Avoid load funds and high fees. Never pay sales loads or excessive ongoing fees like 12b1 fees for mutual funds or annuities. Stick to true no-load funds. Be wary of hot funds. Resist the urge to invest in funds based solely on their recent high performance. Understand that this often indicates hot money chasing past returns, which rarely persists. Scrutinize 401k plans. Actively examine the fees and investment options within your employer-sponsored retirement plans. Push for lower-cost, diversified options, or consider rolling over funds into an IRA if better options exist. Prioritize low-cost index funds. Fund companies like Vanguard, which have a shareholder-owned structure, offer some of the lowest fees and are generally the best choice for index investing. Understand fund ownership. Recognize that most fund companies are marketing firms aiming to collect assets and generate revenue for their parent companies, rather than investment firms solely focused on client returns. Investment strategy, assembling the 4 pillars. This section brings together the previous pillars to outline a coherent, actionable investment strategy focusing on asset allocation, portfolio construction, and maintenance. Key takeaways. Asset allocation is paramount. The most crucial decision is how much of your overall assets to allocate to risky stocks versus riskless short-term bonds/bills. This decision is the only factor affecting your investment risk and return that you can truly control. Historical data for risk, not return. While historical returns are good predictors of future risk, they are not necessarily good predictors of future return. Start conservatively with risk tolerance. If you're a novice, err on the side of conservatism in your stock exposure. It's better to underestimate your risk tolerance and adjust upwards later than to bite off more than you can chew and flee the market after a downturn. Define your stock mix. Global diversification is crucial because foreign stocks often zig when domestic markets zag, providing a cushion during domestic downturns and potentially enhancing long-term returns through rebalancing. Experts suggest foreign stock exposure between 15 and 40% of your stock holdings. Consider size and value splits. While controversial, allocating to small and value stocks can offer additional diversification benefits and potentially higher long-term returns. However, this comes with higher volatility and the risk of tracking error, underperforming the broad market for extended periods. Avoid sector investing. Broad market exposure through index funds already includes all sectors. Attempting to pick winning sectors is difficult and carries the risk of investing in industries that may decline significantly. REITs and precious metals, optional sectors. Real estate investment trusts can offer diversification benefits due to their different behavior from other stock classes. Precious metal stocks can provide inflation protection and uncorrelated returns, especially during market meltdowns. These are optional and should be a small portion of the portfolio due to high volatility. Keep bonds short-term. The primary principle for bond investing is to keep maturities short, typically 1 to 5 years. Longer-term bonds are more vulnerable to interest rate and inflation risks without offering significantly higher returns. Tax structure dictates asset placement. The tax efficiency of different asset classes, such as tax-inefficient REITs and value funds or tax-efficient broad market index funds, should heavily influence where you hold them, taxable versus tax-sheltered accounts. Manage all assets as one portfolio. Treat all your financial assets, retirement, college, emergency, etc., as a single, unified portfolio. Retirement withdrawal rates. A safe withdrawal rate from a retirement portfolio is a complex issue due to market unpredictability. A common guideline is 4 to 5% of the initial portfolio value adjusted for inflation, but this can be optimistic. Prolonged bear markets early in retirement are the worst-case scenario. Young savers benefit from bear markets. For young investors in the accumulation phase, bear markets are beneficial because they allow for the purchase of shares at lower, more attractive prices. Building your portfolio, gradual approach. For novice investors, it's advisable to gradually build up stock exposure over a few years rather than investing a lump sum immediately, allowing time to get accustomed to market fluctuations. Rebalancing is essential. Periodically rebalance your portfolio, selling winners and buying losers to maintain your target asset allocation. This controls risk, can generate a small excess return, and instills crucial investment discipline. The benefits of rebalancing: forces buying low and selling high, reduces risk by diversifying, and helps with psychological conditioning by making you a contrarian. Seek professional help if needed. If you are emotionally unable to execute your investment plan, for example, panicking during downturns or commitment paralysis, consider hiring a fee-only advisor. Notes for daily application. Establish a clear asset allocation policy. This is your investment blueprint. Stick to it through market ups and downs. Diversify globally. Include a significant portion of foreign stocks in your portfolio, even if their recent performance lags. Overweight value, not growth. Consider allocating more to value-oriented index funds and less to growth-oriented ones, especially the smaller ones. Regularly rebalance. Set a schedule, for example, every few years, to rebalance your portfolio back to your target allocations. This disciplined approach forces you to buy low and sell high. Don't watch your portfolio constantly. Infrequent checks can help combat myopic loss aversion and emotional reactions to short-term fluctuations. Save aggressively and early. The most critical factor for a successful retirement is saving a substantial amount and starting as early as possible. Maintain an emergency fund. Keep at least 6 months of living expenses in safe, liquid assets in a taxable account. Educate your children. Introduce them to basic investing concepts and allow them to experience small losses in a controlled environment to build financial resilience. Main idea of the book. The 4 Pillars of Investing demystifies the complex world of finance, arguing that long-term investment success isn't about outsmarting the market, but rather about adhering to fundamental principles. William J. Bernstein emphasizes that risk and reward are inseparable, and attempts to pick winning stocks or time the market are futile. Instead, investors should build broadly diversified, low-cost portfolios, primarily through index funds that reflect their true risk tolerance. He stresses understanding financial history to avoid repeating past speculative follies, recognizing the detrimental psychological biases inherent in human nature, and navigating the often self-serving investment industry. The core message is that disciplined adherence to a sound, diversified, low-cost strategy, rather than seeking excitement or trying to beat the average, is the most reliable path to achieving long-term financial goals and peace of mind. If you enjoyed the content, please consider supporting the author. Thanks for watching, and if you like this video, subscribe. Now, let's go to the next video.